Right, let's go to our featured guest of the morning. He's Gavin Graham, contributing editor of the Internet Investor and Internet Wealth Builder newsletters. Gavin, always great to have you aboard on our show. Thanks, first of all, for joining us. What will be some of the things you'll be watching for, Gavin, in these sets of bank results?
Well, I think, thanks, good to be here, Paul. I think the major factor you have to consider when looking at the banks is have provisions for credit losses peaked out? And secondly, and always the most important factor for the banks, what's the net interest margin looking like? In other words, the difference between what they pay you and me and what they charge us. And most analysts seem to expect that there'll be a little bit of pressure on the net interest margin, that there might be a little bit of a squeeze, a few basis points tightening, because the cost of what they're paying to you and me is continuing to rise, while they may not be actually making up for it by making as many loans. You mentioned the slowing Canadian economy, so therefore if the volumes on the loan side aren't as great and the costs on the deposit side, because they're having to actually pay us finally after a dozen years a decent return on our bank deposits, then you could see the net interest margin being squeezed a little. But having said that, given that we've had almost a tripling of the provisions for credit losses, for example, at people like TD over the last year or so, as things normalized after all the support to businesses through the pandemic, that should be less of a drag. And of course, finally, Paul, the big driver for all financial services business is what are interest rates going to do. And everybody still expects rates to come down, which should help both in terms of the credit losses, potential credit losses, but also in terms of making investors more willing to look at sectors like financials, which are regarded as being interest rate sensitive.
What is your view of the big Canadian banks that are active in the U.S.? One of them, TD Bank, reported, of course, last week. Now, TD Bank, the story there is very unique. The story in the U.S. is clearly the regulatory punishment that the bank looks like it is close to receiving from U.S. authorities. But if you look to other banks that do not have that headwind, Royal, for instance, Bank of Montreal, for instance, what is your view of their U.S. exposure?
Generally, it seems to be going well. The Bank of Montreal, of course, bought Bank of the West, and as the integration of that seems to be going over successfully, Royal put some more capital into City National, its Californian subsidiary. But in both cases now, it looks like things are fairly steady sailing. The returns we've been seeing from US banks, which report, as you know, sort of end of March rather than end of April, generally show fairly healthy numbers. So realistically, it looks like the US side of things is doing okay. As you said, TD has specific problems with the $450 million US fine from the Department of Justice for the anti-money laundering failures, and there may still be more to come. But I think when we talked about this last time, Paul, a few weeks back, it was even with all of that, let's say worst case you end up with a $2 billion fine for TD, which is right at the top end of what most people anticipate might happen. It's less than one quarter's earnings. And again, for all of the Canadian banks, you have very, very generous dividend yields. You're looking at over 5% in the case of TD, over 6% in the case of Bank of Nova Scotia, for example, to console you while you wait for interest rates to finally start falling.
Do you recommend that investors have exposure to this sector at this juncture?
Yes, and amongst the recommendations for income investor, for example, Bank of Nova Scotia, Royal, National Bank, and realistically, you want an exposure to the Canadian banking industry because it's a nice, comfortable oligopoly, very strong profitability, came through the financial crisis of 2008-9 in really good shape compared to other banking systems like the UK or the US. And as I mentioned, you are getting paid a very attractive dividend yield, which is tax effective and which increases over time. So you get a bit of inflation protection. So everybody should have some financials in their portfolio.